Number one rule of Wall Street. Nobody, I don't care if you're Warren Buffett or if you're Jimmy Buffett, nobody knows if the stock is going to go up, down, sideways, or in fucking circles. Least of all stockbrokers. Right? It's all a fugazi. You know what a fugazi is?
No, Fugazi. It's a fake.
Yeah, fugazi. It's a wazi, it's a woozy, it's a fairy dust. It doesn't exist. It's never landed. It is no matter. It's not on the elemental chart. It's not fucking real.
Right.
All right? Right.
Sunday morning, once again, time for another weekly market recap. And there is no need to tell you that the darling of the week, when it came down to economic events or economic data points release, was the CPI, of course. Not the only one, to be fair. I mean, we got also PPI just ahead of it, and then we got retail sales. Now, let's just dive in quickly to look at the economic calendar, because there is a bit of a discussion to be brought up. So, but one step at a time. So, in progression, we got PPI on Tuesday, and it came in a bit lower than expected and a bit lower than the previous data. So that alone, if you like me, you follow a lot the indices or indices futures, mainly the NQ futures or ES, so basically the S&P and the Nasdaq, they started to run to the upside ahead of the actual CPI, because since PPI, it's a component of CPI at the end of it, we are still talking inflation. So if you got producers price inflation ticking down a notch, you might expect that overall this is going to impact the actual bottom line for the headline CPI, because this is factoring the CPI as well. Now, this is not the biggest part, the biggest component of the entire CPI index. Of course, that's for housing and namely shelter. But I mean, still, it's a bit of a potential telltale sign of what may come the next day. And lo and behold, next day we got CPI, which came in line with expectations. The year-over-year read was at 2.9. It's still a bit higher than the previous data point, but at least it didn't surprise to the upside, because right now the big fear for markets, if you remember last week's video, it was about stickier inflation and therefore rate cuts being postponed. Now, not gonna lie, if you check Fed funds futures, they're still pricing in no cuts for the next meeting. So, this curve, it tends to be a bit misleading, especially because essentially you can see these odds shifting around with every tiny piece of news which comes in. So I wouldn't put a lot of weight onto it, especially when you start to go down the curve. But it is also true that lately Jay Powell got us used to not being willing to surprise markets. So trying to come out being in line enough with what markets expectations are. Although, if you do remember, we got the last cut, which was a knockish cut. So again, one thing is what it does, and one thing is how it talks throughout the press conference. So there is the actual decision, and then you got the forward guidance. So it's always up in the air to me, because it's just the market trying to interpret what Jay Powell is trying to communicate for the future. The point is, Jay Powell is trying to communicate something which is based on his assumptions and the border assumptions, and the models they use have been proven wrong many, many times in the past. So it's always kind of the blind, which is leading the blind to some degree, but this is what it is, right? The core CPI month over month came in lower than expected, although, just 10 basis points, what you're going to do, but still, if you look at the overall context, those big fears about reinflation, they seem to be tamed down a bit. And it's crazy, I mean, when you think about it. It's amazing how one week to the other, everything seems to kind of change around when in actual fact it wasn't that much different last week or previous 2 weeks or last month, and it's not that much difference today. So it's just the market going banana at every single piece of news these days. And again, be prepared, because this year or the next 4 years potentially are going to be like that. We are back to those times where every Trump tweet, or how would you call it today? Every Trump X? I don't know. But every time the man speaks, the market is going to dance. So he's going to impact the markets even more than Jay Powell could do, right? Um, Retail sales, again, I always say this is a data that I'm not particularly interested in, if not to time and time again pointing out the fallacy of it, because I'm going to repeat it once again. But when you got the retail sales, you have the nominal value. You don't have it adjusted for inflation. So what happens, for instance, if you see retail sales, the headline, month over month, up 0.4%, which is already lower than expected and lower than the previous read. But when you factor in that inflation month over month for December was 0.4%, basically you didn't have any retail sales growth, right? It's just people paying more to buy the same amount of goods and services. And what could be concerning to some degree is that we are looking at December data. So December, Christmas, holidays and whatnot, you would expect consumers to go out there and maybe, I don't know, maxing out their credit cards in order to spend a very merry Christmas. Doesn't seem like this is the case. So again, it could be worrying. It could be another telltale sign that consumers are a bit tapped out. That paired up together with what we've seen last week about, credit card debt being kind of ran down a bit, or, loans extended out by banks starting to see an uptick in the rate of denial. So, again, a little bit of a contraction, right? That could be. And again, just remember, these things, they take time. It's not like because we got a data point today, next month or next week, it's going to be Armageddon. Long-term trends, macroeconomic data, they take a hell of a lot of time. And we have been basically in this situation for a year plus now, and nothing, not in the real economy yet, nor in financial markets, nothing have broken. So just don't panic. We are just looking at the situation evolving itself, but it doesn't mean you need to run for the hill next week. All right. So with that out of the way, unemployment claims, as usual, nothing really changed drastically again. They came in slightly above expectations and slightly above the previous read, but I'd say it's not concerning so far. And then I've seen this data, the Philly Fed Manufacturing Index. Honestly, I cannot explain it. This uptick, which is massively, yeah, it's a massive uptick. I mean, was expected a minus. No, the previous was minus 16, was expected a minus 5, came in at 44. Uh, I mean, you do with it what you want to do. When you see those discrepancies, like in here, or I don't know. I mean, I get it in here around March, April 2020 when we shut down the global economy. But right now, a big outlier like that, it's kind of, yeah, it looks like the outlier if you compare it to the rest of the data we have been looking at over the last 2 3 months, really. So I don't know, maybe some seasonal adjustments, maybe some math into it. Who knows? Um, let's just say I don't know what to make of it. It's the most honest conclusion I can come up with. On top of all of these, I'll see if I remember to bring it up later on, but we got just at the end of the week, Janet Yellen coming up saying, I don't know if she wrote a letter or anyway, she issued some sort of an alert like we are back to the debt ceiling problem. We got a massive problem with the debt, and therefore we need to take special measurements to prevent the U.S. government to default. And it was strange to me. Like, if I was an American citizen, I would like, I would be like, yeah, we have been having and we have been discussing this debt problem for like the last 20 years. And we know that every time we get near the expiration for the debt ceiling, we need to run political games in the House and in the Senate to get a legislation passed to renew or to extend or to uplift the debt ceiling and to allow the government to keep on functioning. But I mean, Janet Yellen, it's on her way out, so it's just leaving the office, and once she's taking the last step through the door, she looks back at you and saying, "Oh, by the way, there is this." I mean, the right way could have been, I'm leaving now to whoever will come next. Just bear in mind that we got money for another 6 months and then we're going to have a problem. So just start to think ahead of things and try to stay on top of this, because it's going to come, come back and bite you if you just forget it. No, she brought up the argument right here, right now. And I'm like, did, did she want to just to spoil Trump inauguration or Trump first week in office? I don't know, because it looks like now, uh, instead of all the executive orders and whatnot, they're gonna have to start a real debate about the debt ceiling. I don't know. It was a nice parenthesis at the end of the week, and I thought to bring it up first and foremost. So it might be incorporated in what we are going to look up next, but you could also just leave it at that and take it as it is. Political games, maybe, if you do believe in conspiracies, once again, same as could be Powell being massively hawkish when we were talking about, taming inflation, and now, starting to be a bit more dovish to kind of throw a branch throughout Trump's wheels. Uh, I mean, again, it's you never know with these things, right? But let's look at some charts. So let's start out with the DXY, which closed the week relatively stable, should I say? Didn't really go anywhere. What you see in the background with this blue line, that's the 10-year yield. Uh, and it's just there as a guidance, because you got that phenomenon by which currencies tend to chase yields. So, I mean, you see that there is a good enough correlation. Um, I mean, it's not that huge of a deal on an intraday or day by day base, but over a long period of time, you might see this relationship being present more often than not. Now, of course, you can have periods where the relationship kind of breaks apart, but it's just about fundamentals. So you can have deviations from fundamentals, but generally speaking, these two lines, they should track each other pretty much very well. Um, so dollar strength, again, let's zoom out on the weekly time frame, right? Still dollar strength relative to other fiat currencies. And so still on the event of the horizon. No, was the horizon of events? Or what was that about the black hole? Anyway, still on the verge of starting to break things out if it keeps on climbing to the upside, as we always say. Um, Speaking about his peers, the other fiat currencies, not cool. I mean, the euro, it's still weak. Canadian dollar took another deep dive to the downside. Swiss franc still the same, drifting down, but in the grand scheme of things, still in a massive macro range. So not really at the same level of alert of the others. The pound is still particularly weak, and I didn't really put a lot of emphasis on them, but we got data coming out of Great Britain this week, like you got CPI there. I think you also got GDP somewhere like in here, and it was negative. Surprise, surprise. Also, I guess retail sales, yeah, in Great Britain, negative, way farther, sorry, way lower than expected. So, I mean, again, uh, the Brits are not really in a good shape for now. They're not the only one, God forbid, but uh, comparing them to Europe, it looks like at the current moment in time, they're in a situation which is even worse than where Europe is. And Europe is not in a good situation. So, BRICS. Oh, wait, before I forget, the yen had a little bit of a bounce. We are going to see what the BOJ will do shortly. It looks like we are kind of, from a sentiment standpoint, of course, no actual solid evidences, but from a sentiment standpoint, we are back where we start to fear an August debacle 2.1 to 2.0. This morning I can't speak shit. So if they threaten to hike rates, then you start to have fears about the yen carry trade unwinding, and therefore it could impact the rest of the financial system and markets. Will they? I don't honestly know. Well, I think even if they start to be a bit more hawkish, it's going to be short-lived, as I always say. But we'll see. As for the rest, the ruble is still in this range for now. The Indian rupee still weak. Brazilian real it's trying to get stable after the bounce and the interventions by the Banco do Brasil. Hope my Portuguese pronounce was corrected. Probably not, but who cares? Um, and the yuan, we got a few developments in China. I don't know if you noticed. I usually don't cover it. Just a little bit of a hint, but we got one, if not two, massive interventions by the PBOC in the banking system and in the FX market. On one side, trying to stabilize the currency once again to prevent it to keep on falling against the US dollar, but more importantly, they had to step in and kind of inject liquidity into the system. Now they are going through what is called the Golden Week in China, which is basically a period of festivity. And what happens? It's basically some sort of a liquidity seasonal bottleneck because banks are going to be closed and there are festivities around, so people need money to spend. So what do? They go down to the bank and they withdraw a bit of cash, right? So if a lot of people are demanding cash, but there is not enough, what you're going to see is a potential spike in the repo rates because there is basically a liquidity shortage. Uh, and that comes on top of the already dire situation they're living through when it comes down to the currency, the economy, the real estate market. I mean, if you start to add on top of it liquidity issues, it's not a rosy picture. So we'll see. We'll see what they do. I guess it's not gonna be that damning. I mean, I don't think this is gonna be, let's say, the Armageddon plug or the final nail in the coffin for China, but it's still a symptom that something really, it's really not okay, and therefore China, it's still, in my view, on the verge of implosion. All right, so let's have a look at gold now. If you remember, gold closed down last week basically at this resistance or previous resistance, or anyway, relevant level historically. As for the short historical period or price segment, um, at the end of it, it grinded to the upside. It got a little bit of a pullback. We retested, just kissed the previous level, bounced off of it, closed up the week with a, I mean, I would call it strength at this point because the 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 point about strength or weakness when you look at a price movement or a price swing, uh, I'm gonna reiterate once again: this is weak. This is constructive. So this is strong and this is weak. The more constructive, the more order, the more build up you see in a move unfolding itself, the more it's going to be easy to reverse it, because it's kind of the same. Every time price will try to get back down, it's going to find an established base or shelf or structure, order block, you call it what it is. So it's always gonna provide the first type of a support. While if you got a move like this to the downside, it's very inefficient, therefore it's very weak, and you see price will rebalance all of it first and foremost. And in this case, it rebalanced it and then some. Okay, so gold again, I keep on being cautious. How do you say it? Cautiously, with caution, let's say. It's gonna be a hard video to record, I can feel it. So, again, bit of caution, but I'm still relatively bullish on it. I say a bit of, you know, I'm not full on bullish because with these liquidity bottlenecks and hiccups you might start to see, when you got a liquidity issue, although it could be short-lived, depending on the magnitude of it, you might see gold being quickly and temporarily dumped because of liquidity needs. So you're basically liquidating your gold to get the liquidity that you need that you don't have at the current moment in time, right? But other than that, I'm still kind of positive on gold. Bitcoin was brutal this week. If you remember, we left last week saying, yeah, it looks weak, and it was basically at these lows, right? It looks weak. It is true. We have been tapped into this level for a long time now, and 1, 2, 3 times, 4 times. So the level could take the chance of being depleted from a liquidity standpoint. So the liquidity present at the level to sustain price. Then we got this massive spike on a Monday. It was quickly absorbed, and then price just pumped to the other side. And I mean, if I'm not mistaken, I left the Bitcoin chart saying it's really hard to short at these levels. This is what I meant, right? Up until the point you don't see a clean break from a structure after a consolidation which is going ahead for quite a bit of time now. We're talking mid-November, so starting to be like what 2 months, right? Yeah. So you want to have some sort of a degree of confirmation, because going full on bearish or full on bull hard. And it was another liquidity play, basically. We picked up below the lows, probably we shake it out a good chunk of over leveraged positions and participants. And now we are basically almost at new all-time highs. Will we get them? I mean, by the look of it, you might get them, but I quite honestly I would prefer a bit of a pullback here and then trying to go for all-time highs if I had to trade it, like kind of what we got in here, right? See the extension to the upside, 1, 2, then you got the backfill, and then we run. So a little bit of a backfill, getting back into this area, confirming it. Retest, confirmed, it's flipped to support now, and then we can go. That would be the safest way to kind of assess the degree of bullishness of this market. But as we've seen, it could be very tricky. So let's just put it this way. If you want to trade it, if you like to trade it, or if you want to even buy in spot, just bear in mind it could be very volatile in this range up until the point you see a clear and defined breakout out of it. It looks good, but remember, at the same time, back down here last week, it was looking weak, and then we see what came in. So it's a difficult market for now. All right. So don't over leverage, manage your risk, and you might be cool. As for equities, they've seen a good bounce. as well, on top of, on the back of the PPI and CPI data points coming in. Um, Not that much in the Russell. The Dow actually had a good run this week, to be honest. And for the other two, the majors, so the Qs and the Spiders, or in this case, looking at futures, but MQ and ES, not bad. It's a good bounce. We are still operating in this massive structure right here, so we are not really out of the woods, but there's one thing that could be a nice catalyst for a potential upward move or a potential continuation to the upside. So in terms of the structure, if you check the same chart, but we're looking at a price line instead of the candles. I don't know if you're a fan of diagonals, but if you want to try to build up a case for a breakout, a retest, I'm looking at the SPY chart right here, and we reclaimed the moving averages, we retested them, and we pushed to the upside. So it's all good. We might have the green light to keep on moving upwards. Yeah, I mean, guess you can. Um, Technically, I guess it would be a valid point if you do trade like that, or if you do analysis like that. Uh, to be honest, it looks kind of cool, right? Uh, Not really seeing, at least from a technical standpoint, I don't see any major warning at this current moment in time. Now, again, could these markets just pull back once again, maybe retesting the moving averages once again before actually taking off? Yeah, I mean, we have seen at the end of it that this price action segment has been particularly choppy. So I wouldn't discard that. Um, but let's just say if you were concerned about a potential down move, you can kind of take a take a break now, have a little bit of a relief. All right. So it's not completely out of the woods, but let's just say it's starting to be constructive. And I say that because if you check these charts right here, I'm going to bring it up on the screen now. As you may know or may not know, we just entered earning season. All right. So what happens throughout earning season? Well, first of all, corporate share buybacks are halted, I guess 2 weeks ahead of the start of the earnings seasons. But the good thing is that after a company reported earnings, it can open back up the buyback window, so it can keep on or starting to buy back the shares. So that's a huge driver for markets, and over the last 15 years, that was the main driver for market upside. If you net out all the other flows, right, like let's say foreign flows or hedge funds or pension funds, of course they bought, they sold, they bought back in, then they sold, right? At the end of it, over a long period of time, those flows net out zero, right? So the difference, it's just corporate share buyback. Okay, so it's a huge driver for equities demand. All right, and let's just take a look at these. So you see that there is a good enough correlation in between the share repurchases and the stock market returns. Right, so that alone tells you a lot. If you want to just go beyond my narratives, so to speak. And then we see another chart, right? The 4-week average of buybacks compared to the S&P. So basically, this is it's just an histogram. So you see when you got buybacks, the stock market goes up. When you don't have buybacks, or at least they are negative, stock market goes down. So nice relationship. It's pretty evident on this chart, right? Um, Another thing is, if you check the I guess these are estimates, or maybe yeah, forecast, because every single year the companies actually have to state what amount of buybacks they think they are going to do. So we are forecasting 1 trillion, I guess, of buybacks for 2025. So again, macroeconomic data might be dire a little bit, but at the end of it, what drives the stock market? It's just supply and demand, and the money flowing in or out. Um, that doesn't mean, I mean, let's say we got a catastrophic event. That doesn't mean that each and any one of those companies could suspend the buybacks, right? Because if you see something which is really deteriorated, why would you buy now if you expect your own stock to be down in price in the future? Might as well just postpone that purchase and buying back your share at a much favorable price. So it's not guaranteed, but I mean, historically, you can say it's a good enough relationship if you don't have some sort of a black swan event. All right. Um, on the other hand, even earnings estimates, although have been, particularly unbalanced to the upside, they have been revised a bit lower, which is why they call it millennial earning seasons. It's just because everyone gets the trophy, right? So when you think about this dynamic, if you lower the band, it's going to be easier to beat expectations, and therefore you might have a much more positive reaction in the price action as for the single stock, but basically every one of them, right? It's just lowering the expectations so they are way easier to be beaten, and you got a positive feedback in markets. Okay. As for expectation, I mean forecast for earnings, you see that overall earnings they tend to really come in way below expectations and forecasts more often than not, and they tend to gravitate around this long-term trend. And although we might have seen a little bit of a revision, they're still way above what should be the long-term regression trend, or whatever you want to call it. Um, I mean, I don't know about the math, but I mean, if you just check this paragraph right here, that gives you kind of an estimate of where the index should trade at based on the actual returns of these earnings, and assuming an average of P ratio, 25x in this case. I mean, would you believe it? Would you not believe it? We're still in January and we are trying to forecast things out for basically the beginning of 2026. I think it's hard, but I mean, people got to do it, right? Especially those banks which are trying to sell you out Wall Street products. So they need to create that expectations. Otherwise, you're not going to buy those products, right? And we know Wall Street, at the end of it, it's just a selling machine. If you want something, if you got money to buy stuff, they're gonna come up with a new instrument to allow you to deploy your money. That's all they do. Of course, at a fee. They're not going to do it for free, all right? They need to get something out of it. That's what they do. That's their business. Okay. So stocks to me, they might have a good week next week. Bit of a choppiness, I wouldn't discard it, but overall, let's just say I wouldn't expect a lot of weakness. And again, if you think about this weakness we got right here, it could have been just first of all, the lack of a huge buying pressure, no corporate share buybacks, right? Second of all, as we discussed last week, a little bit of an exaggerated sentiment or positioning, which needed to be, you know, tuned down a little bit. And again, I mean, I guess as usual, the final type of reason is that just simply markets don't move in a straight line. You got extensions to the upside and then you got pullbacks. So it's just the ebbs and flows of the markets. Um, I think we might see a little bit of a rally. Just be aware of what may come Monday or Tuesday with inauguration and these supposedly 100 of executive orders or already ready to go. Um, and especially when it comes down to tariffs, it's going to be interesting to look at it, and it's going to be interesting to see what the market reaction will be, because everyone is now waiting to see which tariffs are going to be implemented, or if it's going to be a big bluff, or if it's just a bargaining tool. We'll see. And the market could react particularly negatively or particularly positively. I don't know. Let's just do one an example. Monday afternoon or Tuesday morning, 25% tariffs on China, 10% on everyone else. Europe, Canada, Mexico. Probably not good for markets. Or, the opposite case. The inauguration comes in, no talks. No talks at all about tariffs. And the market, which maybe was so worried, it's going to say, oh, see, it was just a big nothing burger. It's not going to implement them right away. So keep on buying, right? Bid and bid and bid, bid up, bid up, bid up, right? So I mean, the knee-jerk reaction we're going to see in markets is going to be interesting, especially intraday. But to some degree, it's just another risk. So try to factor it in. And again, don't go just gun blazing, buying everything you can put your hands on, right? So after these, I moved oil a little bit down the road, as you can see. Now, oil was to some people a bit of a surprise. Um, I was on the stand, my position, my disposition of it was that I wasn't expecting oil to be particularly bullish for fundamentals reasons. And lo and behold, we got this up move. Now, let's try to think it this way. It is true that on one hand, we have seen 10-year and 5-year break evens ticking to the upside, confirming this up move in oil. That is absolutely true. Just for a minute, think about what we have discussed so far, especially at the beginning of the video, when we have been talking about retail sales, credit expansion, or the lack of hiring, right? Or last week, I remember we did look at the average hourly earnings, credit card debt, all these slowly deteriorating factors. And then you think about these up move or these potential, I mean, I guess you could call it to some degree a bit of a spike in the price of oil, which is mainly due to some sanctions imposed on Russia. So if you think of an oil spike on top of an economy, which potentially it's not as strong as many people are depicting it, that's not really a good thing if you think about it. If you are already tapped out as a consumer, again, remember the US economy, 70%, it's a consumer based economy. If consumers are already tapped out, and on top of it, you got an oil spike, so energy goes up. If energy goes up in price, everything else down the chain goes up because energy is the economy. And the cost of energy is reflected in basically everything down the manufacturing, the services, transportations, and whatnot. So if in this situation, which is already kind of delicate, you add an oil spike, it's kind of like the right hook from Tyson, right? You're already there, you are already wobbling, and then you got this punch financially, right? I mean, how do you think over a long enough period of time the economy should react to it? I'm not talking tomorrow, but maybe, next month, next quarter, something like it. I guess it's not a good thing. And we've seen, especially even in the recent past, if you check all these times oil spiked to the upside, eventually it always came back down because there wasn't really a fundamental and economic reason for oil to trade at such a higher prices. Now, could it be different this time around? Does it mean at the end of it, we achieved the soft landing, the Fed was right, and everything is Goldilocks, and we're gonna see oil trying to get back into the mid 80s, if not 90s? I don't know. I think this is not the case. I could always be wrong, of course, but I don't really see a fundamental case for it. Same with nat gas, right? Nat gas really moved a lot. Now, it's in the nature of the asset, it's very volatile, but again, it's kind of the same with oil. Um, I've been there because I do live in Europe, and throughout the Russian-Ukraine conflict breakout, we suffered from the nat gas price spiking to the upside, and that basically sent Europe into, I mean, not many people are calling it a recession yet, but they're using the term stagflation, standing to Christine Lagarde. But is it really? I mean, it looks like growth is fucked in Europe. So if you don't have growth and you have contraction, or how do you call it? I should ask some people in Germany what are they feeling if they're not feeling recessionary now. But again, so when you got an economy which is already wobbling and you throw on top of it an energy spike, I don't think it's going to be inflationary over a long enough period of time. I mean, it might be inflationary over the short term, and that's the final stroke, right? You're already tapped out. They're gonna come in and saying, you know what, you need to pay even higher prices now, and you're just like, no, I'm giving up. No, I'm cutting back my spending. I can't afford it anymore. I'm sorry, I can't. I tried to keep up as long as I could, but now I can't. I just can't. I'm gonna stop consuming. I'm gonna cut down my spending. I'm gonna make I'm gonna give up on some stuff that I would have liked to buy, but now I can't. And I'm gonna limit my spending to the essentials. So food, energy, of course. You need energy, right? But if energy goes up in price, you're gonna have to reassess your budget. If you're gonna need to spend more on energy, you're gonna have less money to be spent on other stuff. So the stuff that you need, like food and energy, you're gonna keep on paying for them because otherwise you can't survive. But the stuff that you want, so the discretionary spending, leisures and hospitality, trips, restaurants, new clothes, new shoes, new refrigerators, new TVs, but you're not going to be able to afford them. So overall, and this is tricky and this is damning for people because you might see CPI coming down, but they're not going to feel it because if now they're spending all the spending they can afford to make, it's directed to essentials. Those essentials see an inelasticity in demand. Therefore, those prices are going to be stickier compared to the rest of the, I don't know, the CPI basket, so to speak. Okay, so this is why I don't really see a fundamental case for reinflation, reflation, runaway inflation back in the 70s and whatnot. And what we've seen this week, on top of the CPI came in a bit cooler than expected, it's yields drawing back a bit. Now, again, it's not it's not a definitive move, right? At the end of it, even just by looking at the chart, it could very well be a higher low and yields will keep on going higher from here. Especially, again, reconnecting the things, with Janet Yellen coming in saying we got a massive problem with the debt, even talking about default. Uh, could this be that it generates a knee-jerk reaction in markets and yields have another spike to the upside on the back of these sentiment-driven news? Because look, at the end of it, fundamentally, I don't think there is a debt problem in the US. All right, it's not the debt. I mean, I'm not saying having that huge amount of debt or that GDP debt to GDP ratio or deficit, it's a good thing over the long run. I just don't think this talking about the debt. It's just over the short term. It's just not. I mean, it's nothing. They're gonna come in at the 11th hour of the day and they're gonna solve the situation, because what every politician wants at the end of it, it's being able to keep on promising stuff to be re-elected. And to be able to promise stuff to people, you need the budget. So when it comes down to it, it's very hard that they are gonna basically vote themselves out, right? This is why I think that the debt ceiling, it's going to be raised again and raised and raised and raised. Since the times Obama came in, the US, it's not operating on a budget. They're going ahead with this. What was that? It wasn't. I forgot the technical term, but basically every single time they just assess what they need to. You could call it print. You could call it borrow. Anyway, they're not operating on a budget, so it's not like they're putting their heads down on a desk saying, that's what I am allowed to spend this month or this year, this fiscal year. I can't exceed it. So I need to be very careful on how I do deploy my capital and I do invest, I allocate my resources here. No. Do I need to do this? Yeah. So, all right, go ahead and do it. We are going to revise the assessments for government spending. And that's it. Right? So don't see it as a problem for the government, of course. Now, for the people, that's a whole different talk, right? But I'm not seeing the US defaulting on the debt. And as usual, not seeing it defaulting on the debt before anyone else in the system, it's just already defaulted. Conversely, so the bonds had this little bit of a rally throughout this week. Interestingly enough, on Wednesday when CPI was released. So again, in order to understand this whole narrative around bonds, just first of all, let's have a look in a bit more of a detail to what PPI and CPI actually were. So let's start out with these. Okay. Now, this is basically PPI. That should be the headline. And you see that basically, even in here, we are on a downtrending trajectory. Now, if you try to go in the subcomponents of PPI, like for instance, if you exclude food and energy, so the core PPI, again, it's even more downtrending. All right. The problem is, I guess, why we go ahead with the slide here. Look, even if you look at the services, now, do you remember what we've always talked about? It doesn't really matter what the manufacturing sector does in the US, because at the end of it, what's really driving the overall economic output, it's services. Now, even services are seeing disinflation. And there is a little bit of a misconception, I think, when people hear the terms inflation, disinflation. Look, here is explained very, very well. Now, this is a CPI, this is the headline. Disinflation, at the end of it, it's just prices going up at a slower pace. That's it. So when you think about the purchasing power you have lost with the initial spike of inflation when it was really high, right? That is lost. It's not just because now you got disinflation, you're getting that back. In order to get this back, you would need this line to actually trend to the downside, and so having actual deflation. So price is actually coming back lower. Up until the point you got disinflation, although they are trying to spin it as is a good thing, I mean, it's still better than keep on having rampant inflation. I get it, but it's not like I'm better off compared to where I was, let's say in, I don't know, 2007, 2010, 2015, 2020. That purchasing power, it's not coming back. Unless you have a deflationary event like it was 2008, for instance, you're not going to get your purchasing power back. But at the same time, we don't want a deflationary event. And, The first people not wanting this deflationary event are basically at the Fed, because if you got a deflationary event, it's not that easy to keep up the debt and rolling the debt over. All the usual doom and gloom talks about why the so-called central planners they do want inflation to just inflate away the debt. But from our point of view, and if the financial system and the economy weren't rigged or weren't distorted, normally the normality of the business cycle and the economic cycle is having ups and downs. So periods of growth and inflation, and periods of contraction and disinflation and potentially deflation, if market forces would be allowed to do what they need to do instead of continuously intervening and messing around with them. All right. So just a clear point. But as you can see, even the CPI, after it peaked out, uh, yeah, you got ebbs and flows because the economy it's not constant. You got periods and you got also seasonality into it, but you got periods where the economy is going relatively better and periods where the economy is doing relatively worse. So therefore, you see the ebbs and flows even in the CPI. But overall, if you check at the long-term trend, it's still at the very least stuck. Therefore, you can talk about disinflation. All right. And even if you look at the core, basically you exclude food and energy. Again, ebbs and flows, but still disinflation. If you take out the shelter component, CPI would now be below 2%, so below target. Now, again, um, it looks like an easy way to get to the target, right? Uh, Yeah, I mean, if you just select the items or the components that you prefer, obviously you're gonna get to the results you want. Now, I'm just pointing out that when you think about the housing market, when you think about shelter or what was the other owners equivalent rent, those metrics are slow to be moved around because it's a huge market, and it's a market which has dynamics that tend to move very, very slowly. Just think about it. It's not like buying to the local store and buying stuff. When you need to sell or buy a home, there is a huge bureaucracy behind it, and the decisional process is not as quick as saying, you know what, this morning I'm feeling like I want to buy a new pair of shoes. So again, it takes time to adjust and to adapt and to come back in line or to deviate out of economic fundamentals and realities. But eventually it's going to get there, right? So, oh, talking about owners equivalent rent, downtrending again. So even the shelter component of the equation, when it comes down to CPI, it's now trending to the downside, all right? So that's the point about narratives and economic realities. But I mean, if you don't believe it, and if you want to see how nuts the situation is going, just check this out. These are a few metrics which go into the end of it, the inflation CPI reads. Incidentally, and funnily enough, the only two which are ticking up, it's the 5-year break-evens we were looking at before and the 10-year, slightly positive. All the rest came in negative, or it's on a downtrending trajectory. If you think, 1 year expected inflation, 2 years, I mean, you can just read that, right? So among all these components and drivers for inflation, you got just two being slightly positive, and all the rest it's coming down. So again, it's always the same problem about narratives versus realities. Okay, and it gets even crazier than that because this it's basically a representation of how inflation expectations are actually influenced by not how would you want to call it, political belonging, your political stand, right? If you ask Republicans, especially after election, when interviewed, they were all convinced inflation is going to go down because now we got Trump. if you ask Democrats, again, after Trump election, they were all worried. They weren't before Trump gets elected. Oh, we're gonna have rampage in inflation, or we're gonna have inflation, runaway inflation. This madman is gonna send the country into hyperinflation. When if you ask independent, it's kind of stable. So again, the problem with inflation expectations is that the data is always composed and it can be highly influenced by who is answering to the surveys. So you see how crazy it can get. But what we got is a precedent for a Trump term. Now, basically, this is what happened throughout his first term, right? And even then, we got what? Uh, Tax cuts, tariffs imposed on China, and a lot of policies which were aimed to kind of you know favor the national production or industry, if you want to see it like that, a little bit, basically the business. And even then, we go a little bit on maybe not at the level it's going to be this time around, but there were these talks about immigration. Is it good? Is it bad? Maybe we should kind of limit it, right? But again, we didn't see inflation. Although many people are worried about Trump generating, Trumpflation, right? So again, pay attention to the narratives. Now, what happened in the past, it's not guarantee of what is going to happen into the future, but just basing all your assessments on the simple fact that we are going to have inflation because Trump is back in, it doesn't have any fundamental evidence in what was his first term. And, his policies were kind of on the same side of what they will be allegedly this time around too. A little bit of a clarification when it comes down to tax cuts. Now everyone is talking about he's going to cut taxes. Look, there is a fundamental difference in between actually cutting taxes and extending the previous cuts. If you do extend the previous cuts, nothing changes. Corporations, companies, and businesses, they are paying what they have been paid since 2017. Right? Now, if you really cut taxes furthermore, then you might say it could be stimulative, right? But if you just extend what's already there, conditions are not going to change. Again, this is something which is going around on YouTube a lot, I've seen. So, I mean, it is pretty fucking elementary when you think about it. It's just plain English, right? Although I've proven time and time again, I got a very slippery tongue, but I can read, right? So, I mean, just take it for what it is. It's also true that when it comes down, as we've seen for equities, to price to earnings, revenues, looks like a lot of revenues for the S&P 500 comes actually from abroad. And we have looked at, or at least we have touched just briefly on Germany, on Japan, on China, on Brazil, on the rest of Europe, on the UK. What do you think is going to happen if the rest of the world goes into some sort of a contraction or a recession? What's going to happen to that foreign demand and therefore foreign revenues? And if those revenues go basically away, what do you think is going to happen to the bottom line of these companies as for revenues? And again, if those revenues just go down, what do you think is going to happen to the margin profits? So it's all connected, all right? And again, is it inflationary or at least disinflationary? Or nothing changes if you want to be kind of benign, right? So again, look, where are you going to import inflation in the US? From the main trading partners? Europe? UK? China? they are already ahead on the path of disinflation. China is actually on the verge of deflation. It was there, then he had this little bit of a relief rally, but it looks very weak. So look, this is the components for what came in for the CPI. And even the housing, which is weighted 45% on in the overall index, again, it's slow. It's fucking slow. But if you start to look at it from August, fucking Americans using dates written inverted with the month ahead. But from August, right? August, September, October, yeah, it's coming down slowly but surely. It's coming down. So even the you know when you think about the national rent index and all which is factoring in the household and shelter components, eventually it's going to go down, right? And that's not inflationary by nature. And even when, as we did last week, you look at real wages, if they don't keep up with the rate of inflation, you're not going to be able to generate further inflation down the road. So this is all interesting because it's particularly connected to what we have seen in the bond market or what we have seen with yields. So when you hear about all these narratives about inflation or about the debt or about the US going into default and what's going to come from it, I'm going to end the video with these. I don't want to call it a debunk, but it's just, again, another narrative like the Paul Volcker myth that I don't really stick in when it comes down to face economical realities. The bonds vigilantes, the fucking bonds vigilantes. You go on whatever, you go on YouTube, yeah, you type in bonds vigilantes, it's full of people calling for the infamous bonds vigilantes coming back in. And if you don't know what they are, or what they are supposed to be, so basically the and again, I'm going to call it for what it is. The legend basically says that if a government is not going to be fiscally responsible, it's not going to be prudent, you're going to get these bonds vigilantes driving yields up and bonds down, so that it's going to be very, very hard for that government to fund himself, or itself, should I say, and being able to keep on functioning. So basically, they are just there to measure the degree of responsibility of each government. And I mean, I get the point of, if I see risk, like any other type of credit risk, the higher the risk, the higher the yield I'm going to ask for being compensated of the risk I'm taking. And that's a totally understandable argument. But the thing about being vigilante, so being someone which allegedly it's operating for the greater good, to keep the government in check so that the country will be better off, that's fucking nonsense to me. Like, look, as you may remember or may not, I recorded a few videos. Like, I recorded this one, Paul Tudor Jones. It fits right in. Now, when you look at him, would you say he's a bond vigilante? Him, Guntlock, Druckenmiller, Ackman, are they bonds vigilantes in the sense, are they trying to do what's best for the interests of the nation, or are they trying to make some money for themselves? When you start thinking about it, which one is true and which one is not? It's just the usual Wall Street type of a trade. Everyone start to be a bit bearish on something, that something starts to go down, and everyone piles in, keep on shorting it on the narrative and on the claims of these big guys like Paul Tudor Jones. Funnily enough, at the end of it, and I guess this video is 2 months old now, right? Funnily enough, although he was right on the direction for the bonds, but when you look at the actual underlying economic realities when it comes down to CPI and inflation, we got no inflation and no inflationary environment so far. So looking back at it, like I might say I was wrong on the direction as for the prices, for the price of the bonds, but I'm still right on the fundamental premise because its interview was his interview was about there is no other way around. The only path ahead of inflation, it's inflation or something like it. Which again, 2 months in or 3 months in, I don't remember correctly, but still, it's not like that. And everything we've seen in bonds, as we discussed last week with the model for the yields and whatnot, it's just sentiment. And I know that the bonds market should price in fundamentals. And it's not like the stock market where irrationality can really take the driving seat. But sentiment plays a role in the bond market to a lesser degree, but it does. What do you think if you look at the 10-year yield being around 4.6%, while you got GDP at 3%, inflation below 3%, what do you think these differences from 3 to 4.6? That is just sentiment. Try to think of it like if you think about stocks, right? When you think about stocks and you think about people being willing to pay a much higher premium to buy a stock on the promise of future earnings growth, and therefore you got price to earning ratios which are in the 20s or above the 20s. Basically, you're buying something which could be considered 25x overvalued compared to its uh, real fundamentals. But you're buying it anyway because you think over the long run those fundamentals will actually kick in, even if they don't. It's the same with the bonds. You might keep on shorting the bonds or demanding a higher yield because you think that long term that's the path ahead. But the economic fundamentals are not actually reflecting it. So at a point, you're going to have a mean reversion and a shift in the sentiment. It's like, being over optimistic and all of a sudden something changes in the price action and everyone shifts to the other side of the boat and they become pessimistic. It's kind of the same. And again, to beat down once more these bonds vigilantes, I guess the connotation of the term vigilante, right? If you think about the Batman, right? I mean, the Batman, he might be a vigilante, he might be um, a rogue one, he might operate outside the boundaries of the law, but he's doing it for the greater good. He's chasing out and taking down bad guys. When you think about what these so-called vigilantes are actually doing, if they keep on piling in on shorts, so driving the asset price down and conversely driving the yields to the upside, who are they really helping? Because they are not helping your moms and pops. As we discussed last week, for the real economy, for the real people, these are the rates which are actually impacting their lives. It's not Fed funds. Moms and pops, they don't borrow Fed funds. Buy a car, buy a refrigerator, buy a TV, buy an Apple, buy a house. You're borrowing at what? 3, 5, 7, 10, 20 years. You're borrowing at these rates. And if these rates keep on going higher on top of an energy spike, so it's a double whammy, energy spike, energy costing more, it's reflected down all the economic chain, interest rates going up, so the cost of money it's going up, therefore credit it's much more expensive now, and we do live in a debt-based economy. So if you don't expand money supply, if you don't expand credit, if you don't extend credit, the system is not designed to be stable. The system is designed to be increased and to expand. If it doesn't expand, it contracts, and when it contracts, you got a recession or a financial crisis. You call it what you want. So Are they vigilantes in the sense that they are doing things for the greater good, or what they're doing is actually impacting in a negative way those very people which they should supposedly save and defend? But again, they're making a hell of a lot of money in the process. So this thing about vigilante, it's complete nonsense and has been brought up till the 80s. They never came back, and all of a sudden it looks like they're doing it now. Look, they might really try to drive yields up and up and up and up. I'm just saying they're not doing it because they do care about the good functioning of the US government or any other government for what matters. They are like sharks. They smell the blood, they go nuts. They see an opportunity, they seize it. They don't care who's gonna be hurt or who's gonna be, protected. It's just a matter of money. There's no fairy tale bullshit vigilantes for the greater good. Absolutely not. So forget it. All right. Just a little bit of a rant to end up the video. Okay. So after that, I think we don't have really anything else to discuss. If not, well, final note. Do you remember we've seen this chart last week about the outflows in the TLT? If I can, okay. Um, and we said might be at a point, maybe not now. It might be a good time to buy bonds in the long end. Conversely, you got a huge amount of short interest on the same asset. So again, these bounce right here, is it really something definitive or it's just short closing, short covering? Again, I don't think something really changed overall. Didn't change in the trend of the bonds, but again, didn't change in the fundamental aspects. So again, sooner or later, it's gonna come. You're gonna see disinflation. And bonds are gonna be, again, I keep on thinking they're gonna be a good opportunity. Might take a few weeks, might take a few months. I think throughout all 2025, that will be a good period to be in bonds. And with that, want to wish you, as usual, a good rest of your Sunday and a good start of your next week. Remember to be nice and be cool. Nails out.
Mm-hmm. 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 Mm-hmm.